You think you've covered the big stuff: bank account split, mortgage sorted, custody agreed. You feel ready to walk out the door and start fresh. But behind the scenes, there are assets hiding in plain sight, values you built over years that can vanish faster than your boxes leave the house. Your retirement accounts? They might be in your name, but without a proper QDRO, sudden freeze or division order can slice decades of compound growth overnight. That life insurance policy you set up for peace of mind? Change the beneficiary list by mistake or let a premium lapse, and the safety net unravels. Your side business, that quiet partnership you never thought to disclose, it's just one clause in an operating agreement away from being sold out from under you. Digital fortunes, from crypto wallets to domain names, slip through gaps the moment you're distracted. Collections of art, watches, even that rare wine stash can disappear if they're not inventoried and legally scheduled. And don't forget the vacation place you never refinanced. Your name can stay on the hook long after you've left. Meanwhile, joint credit lines and cosign loans lurk on your report, ready to tank your score if unpaid, in your personal brand. YouTube channels, email lists, that following you built can be claimed as marital property if unprotected. If you think an amicable split means a clean break, think again. These 8 assets most men overlook can drain your future in silence. Before you walk away, you need to lock them down, because once they're gone, it's often too late to get them back. Your retirement accounts feel untouchable. You've been contributing year after year, watching that balance grow, and you've always assumed it's in my name is enough. But once divorce papers hit the court, those accounts go from personal savings to marital property, and without a qualified domestic relations order in place, you could see your 401k, IRA, or pension frozen, tapped, or split without warning. Here's how it plays out. You finish work one day, check your retirement balance, and feel secure. The next day, your attorney files divorce documents. Suddenly, your plan administrator gets a notice. Don't move any money until further notice. No loans, no withdrawals, no rollovers. Even required minimum distributions get held up. That freeze prevents you from accessing the funds if you needed to cover temporary legal fees or living expenses, and it gives your ex leverage to demand more in spousal support, knowing you can't tap that nest egg. Even if you eventually agree to split the account, time is against you. The moment your ex's share moves into her own IRA or 401k, it remains invested, compounding tax deferred. Your half, stuck in limbo, misses out on market rebounds and dividends. If you try to withdraw early to catch up, you trigger a 10% penalty plus ordinary income tax on the full amount, shrinking the very cushion you hoped would help you through the transition. The solution is proactive. File a draft QDRO as part of your temporary orders so the court and plan administrators know exactly how to divide the balance, and that no other movement is allowed. Work with a retirement specialist and your attorney to nail down precise language, percentage splits, handling of future contributions, and timing of distributions. That way, your life's work stays protected, accessible on your terms, and continues to grow until final settlement and beyond. Because in an amicable split, the last thing you want is for your long-term security to become collateral damage. Life insurance policies are your silent safety net, and they can unravel without a fight if you don't lock them down before you leave. Most men set up policies to protect their families, name their spouse or kids as beneficiaries, and assume that once it's in place, it's bulletproof. In reality, beneficiaries can be changed with a simple form, premiums can lapse if someone forgets a payment, and corporate moves by insurers can alter policy terms, sometimes without direct notice to you. Imagine you walk out knowing the policy is assigned to your ex and children. You move on. A year later, you receive a notice. Premium not paid, policy terminated. You scramble to reinstate it, only to discover that without ongoing payments in both names or collateral assignment provisions, you have no leverage. Your ex could claim she never got the invoice. You could claim you thought she'd continue payments. Meanwhile, the death benefit that was supposed to secure your children's future is gone. Even if premiums stay current, you might miss subtle but critical details. Some policies require proof of insurability upon policy conversion or significant term changes. If your ex remarries and decides to convert the policy to a new term life plan, taking advantage of lower rates at a younger age, she could restructure the coverage entirely, cutting your children out, all under the guise of a standard policy amendment. And then there's the ownership structure. If you own the policy personally, a divorce decree assigning proceeds isn't automatically enforceable against the insurer. You need an irrevocable beneficiary designation or collateral assignment that names your spouse/children directly and requires the insurer's acknowledgement. Without that, your ex's attorney could argue that the decree doesn't bind the insurer, leaving you to fight another day in court. The only way to protect life insurance before walking out is to treat it like any other asset. Document who owns it, who pays the premiums, and who receives the benefits, including a process for reinstatement or modification. Request the insurer provide written confirmation of beneficiary designations and payment history. If possible, change the policy to a joint ownership or irrevocable trust, naming your children as ultimate beneficiaries with your ex as custodian. That way, no single signature or missed invoice can erase the safety net you built. Because in an amicable split, life insurance isn't just paperwork, it's a guarantee. Don't let it become an afterthought you can't recover from. Your side hustle, partnership stake, or even a silent investor role might feel too small to mention, but in divorce, every business interest counts. If you own shares in LLC, are a partner in a family firm, or have a minority stake in a startup, failing to address those interests before you walk out can leave you exposed. Operating agreements often include buy-sell or right of first refusal clauses triggered by divorce, meaning your ex or the company can force you to sell your shares at a discount or refuse to recognize your stake altogether. Imagine you've invested sweat equity into a small tech venture. You and your spouse agreed the business would stay yours post-split. You move on, only to get served with a demand. Under the operating agreement, any member transferring ownership must offer shares back to the company or other partners first, and spouses fall under transfer definitions. Suddenly, your long-term project is at risk of being bought out by your ex or sidelined by other partners who object to your continued involvement. Even if the agreement doesn't mention divorce explicitly, vague definitions of transfer or change in ownership can be interpreted broadly. And if shares are held in a family trust or corporate entity, you might need to untangle years of layered ownership to prove your individual rights. That process can be costly and time-consuming, and without clear pre-divorce documentation of your contributions and percentage interest, you may fail to establish claim to what you built. To protect your business before walking away, get proactive. Review every operating, partnership, or shareholder agreement for transfer restrictions triggered by divorce. If those clauses exist, negotiate amendments or waivers, ideally in writing, with company and partner sign-off before filing papers. Document your capital contributions, roles, and revenue allocations thoroughly, and consider converting your stake into a separate entity or trust that isolates it from marital property. Additionally, secure a buy-sell agreement amendment that fixes your valuation method upon divorce, so you aren't stuck with a forced sale at an arbitrary price. If other partners resist, insist on mediation or binding appraisal processes written into the amendment. In an amicable split, business interests can feel too complex to tackle amid emotional upheaval, but leaving them unaddressed invites partners or your ex to hijack your entrepreneurial future. Lock down your stake with clear legal terms and valuation safeguards, and ensure that what you built under your own sweat remains squarely in your hands. Your email list, website, crypto wallets, and social media followings aren't just hobbies. They're assets with real value, and divorces treat them like any other property. Without clear ownership records and transfer agreements, these digital riches can vanish overnight. Imagine you built a lucrative online newsletter with thousands of paying subscribers. You and your ex agreed the profits would be split, but you never updated account ownership. After you move out, she changes the login email and password, and your 50% share becomes zero. Cryptocurrencies carry an even higher risk. If you hold Bitcoin or Ethereum in a personal wallet, and you didn't document exact wallet addresses, private key guardianship, or purchase dates, your ex could claim the coins were a joint purchase or marital asset, then freeze access while disputing your ownership. Exchanges don't mediate marital disagreements. They simply follow the account holder's requests. Without ahead-of-time agreements specifying how digital wallets get split and ensuring both parties have secure backups, you could lose access to tens of thousands in tokens before you even realize it. Domain names and revenue-generating websites pose a similar threat. Registered under joint information or your joint business entity, domains can be transferred to new registrants with nothing more than an email verification, an email you might no longer control. The traffic, ad revenue, affiliate income, all disappear when the domain pops out of your hands. Secure these assets by creating a digital asset schedule in your separation agreement. List every platform, wallet address, domain, and revenue stream. Specify login credentials, held by a trusted attorney or escrow, split percentages, and a process for account transfers. If necessary, engage a digital asset expert to audit your holdings and verify purchase dates, transaction histories, and platform ownership rules. In a peaceful divorce, it's easy to overlook the intangible. But in a world where a single wallet address can represent a small fortune, leaving your digital life unprotected is a risk you can't afford. Lock down every key, credential, and contract, because once those online treasures slip away, retrieving them can be nearly impossible. Collectibles, art, jewelry, luxury watches, even that rare wine collection you've been curating, all carry hidden value that handshake agreements and general property splits miss entirely. When you agree to let her pick what she wants first or to draft a shortlist later, you open the door for undervaluation and outright disappearance. Without a detailed inventory and formal title transfers, those prized items become lost or get quietly sold off, leaving you empty-handed. Think you can trust your ex to return every piece? Imagine the divorce is finalized, and months later you find your vintage Rolex listed on an online auction site, your name long removed from the original purchase protection, or your limited edition artwork surfaces in a gallery show without your signature on the provenance. Firearms stored in a safe? If they're joint property, you may need background checks and transfer paperwork you never filed, turning a simple return into a legal headache. Even if you both sign off on a schedule of personal property, lack of appraisals can leave you at the mercy of whoever writes the blanks. That nice watch can vary in value by thousands depending on model, condition, and market demand. When it's time to swap, you'll find yourself overpaying, or worse, trading away something irreplaceable for common items. The solution lies in preemptive documentation. Commission certified appraisals for every collectible before you file. Photograph each item clearly, record serial numbers, condition reports, and provenance documents. Include these in your separation agreement with explicit language. Party A retains sole ownership of the item described as Rolex Submariner, serial number 12345. Party B retains sole ownership of the item described as Oil Painting by Artist X, 1995, signed. Require immediate title transfers for firearms through authorized dealers, with copies of ATF paperwork attached. By locking in values and ownership in black and white terms, and backing them with professional appraisals, you prevent personal property from becoming the silent casualty of a friendly divorce. Because when emotions cool and memories fade, those tangible reminders you once cherished can vanish in the shadows of vague agreements. Jointly owned vacation homes, timeshares, and investment properties often feel like shared getaways, not battlefields. But in divorce, they could trap you long after you've walked away. You might assume that letting her keep the beach condo or the ski chalet means you're done with the bills. Instead, without a formal deed transfer or mortgage release, you remain legally responsible for property taxes, HOA fees, and mortgage payments, even if you haven't set foot there in years. Take timeshares. You agree to assign her the annual week, and she promises to cover the maintenance dues. But management companies have complex fee structures and often tack on unexpected special assessments. If the agreement doesn't explicitly release you from those future fees, you'll keep getting invoices for decades, your credit score tanking with each missed payment. Vacation homes pose an even bigger risk. Refinancing in her name only sounds straightforward, but banks don't automatically remove your liability. If her application falters due to credit or income issues, the original mortgage stays in place. A single late or missed payment shows up on your report, and you face foreclosure threats for a property you don't even visit. Meanwhile, if the settlement didn't stipulate a clear timeline and conditions for property transfer, you're stuck waiting indefinitely while fees and interest accumulate. The fix is clear. Update the deed with a quitclaim or warranty deed and secure a mortgage release or refinance clause that mandates lender approval within a set period, say 90 days. For timeshares, obtain a written release from the management company that names you as the only exempt party from future assessments. Include language in your agreement specifying that any invoices sent to you after settlement are her responsibility, along with a requirement for her to indemnify you against related claims. Without these precise steps, the sunlit memories of your vacation property turn into shadowy liabilities lurking behind your credit report. Lock down deeds, mortgages, and management contracts before you leave, so you truly leave the property, not the debt. Joint credit cards and co-sign loans might seem harmless until your ex stops paying, and suddenly your credit score takes the hit. You leave on friendly terms, believing shared accounts will be closed or separated quickly, but banks don't act on handshakes. They act on signed requests, and those often get buried in divorce paperwork. If a joint card stays active, any missed minimum payment or unexpected fee shows up on your report. That single late notice can drop your score by dozens of points, inflating mortgage rates, auto loan costs, and even your car insurance premiums. Think it can't happen because you trust her? Even responsible people face job loss, medical emergencies, or simple forgetfulness. Meanwhile, lines of credit, Helix personal loans, even student loans you co-signed, can accumulate interest, fees, or balances that catch you by surprise. You might never see the statement, but the credit bureau does, and each negative mark stays for years. Resolving it after the fact isn't easy. You'll need to close accounts, remove your name, and dispute every blemish. But lenders won't release you until the jointly owed balance is paid in full. You could end up refinancing at a higher rate to cover what should have been her responsibility, prolonging your financial recovery. The antidote is preemptive. Demand immediate account separation in your settlement with specific deadlines. By day 30, all joint accounts will be closed or converted to single name. Any remaining balances will be paid or allocated as follows. Then verify closure. Get written confirmation from banks and credit bureaus. Freeze or replace cards if needed. Update auto pay instructions and monitor your credit through a trusted service for at least 12 months. By treating your credit profile like any other marital asset, you ensure that moving out doesn't mean moving into a financial minefield. Because peace of mind in divorce doesn't end with signing papers. It begins with locking down every liability that could derail your future. Your personal brand, YouTube channel, podcast, blog, email list might feel like your identity, not marital property, until you discover it's lumped in with the rest. If you build an audience together or use joint accounts to manage subscriptions, that online following legally counts as an asset. Without clear ownership and transfer agreements, your ex can change passwords, redirect revenue streams, or even monetize your work without your permission. Imagine you walk out owning 70% of a channel that brings in ad revenue, sponsorships, and affiliate commissions. You agree she can keep 30%, and you split the rest. But post-divorce, she revokes your payment processor access, changes the channel's email, or rebrands the platform under a name. You've effectively lost control of the business you built. Subscribers can't tell the difference, and revenue checks go to an account you no longer see. Even dormant assets, like a domain name you registered years ago, can vanish if it's under a joint registration. Your tranquil, "I'll just keep it running" approach leaves you vulnerable. Domains expire, Hosting accounts get deleted for non-payment, and social handles get reassigned if unclaimed. Suddenly, your online legacy and potential income streams are gone. To protect your digital empire, list every property, channels, sites, social accounts, email platforms in your settlement agreement with exact URLs, login credentials, and revenue sources. Specify who owns what percentage, how revenue is split, and require that both parties hold multi-factor authentication on all accounts until transfers are complete. If possible, move joint assets into a single-member LLC or trust before filing, with you as the sole manager. That way, the company retains ownership, and your divorce decree changes nothing. Lock down your digital footprint now, because walking out without these protections means your friendly split could erase the brand you've spent years building. Take control of the logins, the legal entities, and the revenue splits before your audience and income disappear in a single click. Walking out on good terms feels like the smart move until you wake up to frozen retirement plans, lapsed life policies, vanished business stakes, locked-out crypto wallets, missing collectibles, unreleased property deeds, ruined credit scores, and lost digital brands. These 8 assets hide in plain sight, waiting to slip through the cracks of an amicable split. The solution isn't conflict, it's clarity. Before you pack a box, map out every account, policy, and interest with your attorney. File QDROs alongside your divorce petition. Lock in beneficiary designations. Amend partnership and operating agreements. Draft digital asset schedules. Update deeds and mortgages. Separate credit lines. And place your online platforms into entities you fully control. Because peace on paper means nothing if your future disappears in silence. Take the time now to protect what you've built: retirement, insurance, businesses, digital empires, and personal property alike, so that walking away truly means moving forward. Your next chapter deserves a foundation as secure as the one you left behind.